Okay, hello class. I hope you're having a good day today. I want to make a brief video here today about chapter 12, at least the first half or two-thirds of chapter 12, I think may require a little additional explanation or hopefully a little enlightenment from your professor here. This is a pretty readable chapter, but at any rate, some of the relationships dealing with how exchange rates are established and how they are moved and so forth, I think is something that we should spend a little time together on. So I'm going to pull up the PowerPoint slides here and have this kind of a little bit in a split screen, but hopefully you can see these slides easily enough. So exchange rate determination. So chapter 12 in your book by Bay, 18th edition. So here's the outline of the chapter. We won't talk about all of these things in this video, but most of these we will. We'll talk about what determines the exchange rates in section 1, determining long run exchange rates. There in section 2, you see the long run expressed again in section 3 as it relates or as results from inflation rates, purchasing power parity, and so forth. And then you see the word short run in section 4. So what we recognize in this chapter is that there are forces that affect the exchange rate between currencies that are time dependent. Some are long-term rates, some are or long run rates, some are short run rates, and some are medium run forces. That is to say. So at any rate, we'll look at each of these time frames in turn. Um, just kind of a quick review what we mean by exchange rates. Exchange rates are the price of one currency in terms of another. For an American, say, we may work with either a direct exchange rate or an indirect exchange rate. The direct exchange rate is a ratio of two values, equal values, by the way, uh, say $1.50 and 100 yen, or let's see, I changed it. Let's go back to £1. Okay, one British pound here. So if $1.50 is equal to a British pound, then the ratio of $1.50 to a British pound is really equal to one. This is a fraction that's equal to one because the numerator and denominator have the same value. They're just expressed in different units. The direct exchange puts the domestic currency on top and the foreign currency on the bottom. The indirect exchange rate puts the foreign currency on top and the domestic currency on the bottom. So for an American, the direct exchange rate has dollars on top, and indirect exchange rate has dollars on the bottom. So if you wanted to say convert $150 to pounds, then you would use the indirect exchange rate as a conversion factor. So this thing inside the parentheses there on the right is equal to one, so you're not really changing the value of $150. You're, though, able to rewrite $150 in a different unit in British pounds, because when we multiply $150 by this particular factor, we see the dollars cancel and pounds is left on top. So that would allow us to convert dollars to pounds. Alternatively, we might want to convert 200 pounds to dollars, in which case we would take the 200 pounds and multiply by the direct exchange rate for an American. Of course, that'd be the indirect exchange for a UK citizen. So when you put the domestic currency on top, that is the direct exchange rate. So at any rate, a little review there. We're going to talk about now in section 1 what determines exchange rates. There are two things in particular that determine exchange rates. That is the price of one currency in terms of another. First are market fundamentals. These are just real economic variables that should impinge upon the value of one currency upon another. So productivity, productivities of each the citizens of each country, inflation rates, real interest rates, consumer preferences, and then government trade policy. We'll be looking at each of these. You have 4 or 5 broad categories here. We'll look at how these changes in these fundamentals will affect the exchange rates. We'll look at each of these in turn here in just a minute. Also, expectations of where these fundamental economic variables will be in the future will push exchange rates today. So if you have news about future market fundamentals, that is, for instance, there's going to be going forward an uptick in inflation in the United States because of expansionary monetary policy or something like that, then that will affect then the exchange rate between the dollar and other currencies. And we're going to see here in a minute what that linkage would be. Traders' opinions about future exchange rates. So if you think, for instance, that the dollar will appreciate against the British pound, and we'll be talking also about the yen, the Japanese yen, and the Swiss franc, and so forth. There's a handful of currencies we could defer to, but a lot of times we'll, in this discussion, talk about the British pound. So if you have the idea, say, that the US dollar will appreciate at some point in the future against the British pound, then you may want to go ahead and invest in dollars today. That is, if you have pounds, you may want to trade those in for dollars because you know that in the future, the dollar is going to be worth more with respect to the pound. That's called an appreciation. If you think the dollar is going to appreciate with respect to the pound, we could go back and look at any one of these rates here. If you think the dollar is going to appreciate against the pound, then perhaps this particular conversion factor here, exchange rate, that is $1.50 would equal 1 pound, may move to say $1.40 equals 1 pound. So it take fewer dollars to purchase a pound in the future. That's what you would expect if you're expecting the exchange the dollar to appreciate. Okay, so that would be an appreciable move. Okay, the dollar would appreciate if it against the pound if it moved from $1.50 to $1.40. It would depreciate if it moves from $1.40 to $1.50. In this case, it takes more dollars to purchase a pound than before. So at any rate, if you have again an opinion about how that's going to move in the future, then that'll affect exchange rates today as people try to get ahead of that movement. So they're both there are short run determinants, if you will, of exchange rates, medium run and long run determinants or factors that determine the exchange rate. So these all work together so that on any particular day, the exchange rate between two currencies will be a certain ratio. Okay, so we had $1.50 per pound, $1.5 equals 1 pound. There are forces that drive that in the short run, medium run, and long run. I will say that the long run is more governed by market fundamentals, if you will, and the short run is driven more by speculative activity, people who invest in financials, primarily financial, but also real assets. But in the short run, we're talking about fluctuations in the exchange rate that are due to speculative activity. And so there's always a difference in interest rates, in particular real interest rates that will steer investors in one direction, say toward the United States as opposed to Great Britain or vice versa. And this is based on something we'll call the Fisher equation. We'll come back to this in a minute. This is just an overview of where we're going. But this is, I guess we'll look at each of these in separate. But if you look at let's just go right here we'll come back to this slide, figure 12.1, you'll see that short run fluctuations like this little dashed line here is driven by speculative activity. The differences in real exchange rates that make, say, government bonds, say, in one country more profitable with respect to government bonds, investing in government bonds in the other country, and so forth. So, I guess if we had started down here, I took this slide as given from the publisher, but I like starting with the long run first, which the long run forces that impinge on the exchange rate, try to drive it along a kind of a straight line, like you see in this diagram here. Here they've got the yen. They could have used the British pound, but we're kind of jumping around a little bit. This is the yen's value, traded value on the vertical axis. So when we say the yen's value, we're talking about pricing the yen in terms of, say, the dollar. If we talked about the value of a gallon of gasoline, that would be pricing a gallon of gasoline in dollars. You'd have dollars per gallon. Okay. When you talk about the yen's value, that would be dollars per yen. So any curve like this blue curve, say, that's moving upward from left to right, is suggesting that over time, and here we got a couple of decade span, I suppose, that, or at least one decade, over time, the value of the yen is appreciating. That is to say, the yen is appreciating. That is to say that it takes more dollars to purchase a yen in 2003 than it did in 1991. So at any rate, there are long run forces that kind of push it along a straight line like this. And those forces are these economic fundamentals that we'll be talking about, like inflation rates, investment profitability, consumer taste, productivity, and government trade policies. Those are things, okay, that tend to push the value of the yen with respect to the dollar, say, along more or less a straight line over time. Now, there are along that way, there are fluctuations, forces that would try to cause the exchange rate to fluctuate back and forth about this long run trend line. And these are called cyclical factors. Okay, so they operate more or less in the medium run. And these are fluctuations in economic activity, primarily recessions and expansions in each of the macro economies. So if we're talking again about Japan and the United States, and we're looking at what affects the value of the yen in terms of dollars over time, then it could be that a recession that would be occurring in the United States, say, but not in Japan. If the United States enters a recession, but Japan does not, that might cause maybe an uptick, maybe this little up cycle here in the exchange rate. So the value of the yen with respect to the dollar. So investors would want to go in Japan, say, more than they would into the United States. If the United States is entering a recession, Japan may be experiencing an expansion. So that would be a favorable situation for Japan and might cause the Japanese currency, the yen, to appreciate more over time. So cyclical movements in the exchange rates are due to fluctuations in economic activity, primarily recessions and expansions. And those things affect imports and exports. Again, if there were a recession in the United States, then there would be, that would affect imports and exports and so forth, and also asset values and so forth. So, but at any rate, we'll talk a little bit more in detail with the graph we'll look at here in just a second. In the short run, you can have fluctuations about the cycle. Okay, you can have departures from the cycle, like you have this little tangent spin off here, and these are due primarily to sudden announcements and sudden bits of information that come out about the economy. So, if the Federal Reserve Board of the United States comes out and says in one of their regular meetings, they have every 6 weeks a meeting of the FOMC, Federal Open Market committee, and they say, okay, we're going to lower interest rates in the United States. If they lower interest rates, nominal interest rates, that is the rate you can earn, say, on a treasury bill, actually they push federal funds rates, which are even shorter term than treasury bills. But at any rate, if it affects, say, they come out with an announcement that lowers the rate on treasury bills, and that would also lower the real interest rates on treasury bills. By the way, a real interest rate is the real interest rate. It's the nominal rate minus the inflation rate. And that's called the Fisher equation. Okay. You may have known that from your principles level class, but say if the T-bill rate is 5% and the inflation rate is 3%, the real rate then would be 2%, the difference in those two. So at any rate, any sudden announcement that will affect, say, the real interest rate is going to affect the direction in which investors are going to want to go in their purchase of T-bills and so forth. So at any rate, it's those kind of announcements and those timely news items that come out from time to time that would cause the exchange rate to even depart from this cyclical movement about trend. Okay, and so what you have after these three different types of forces that we talk about here, the short run, medium run, and long run, is you get a very sometimes erratic looking time series that applies to a exchange rate. Okay, so if we were to actually graph going back here, the yen exchange rate, the yen's value in terms of the dollars, so this would be dollars per yen. If we were to actually graph that over time, day to day, it might be jumping all over the place, but it would be primarily constructed from these three different types of forces we talk about here. So we want to talk about now what does determine the exchange rates. Okay, so we're going to talk about, okay, what first off inclines an exchange rate to move along this blue arrow here, the long run rate. What things are at work to move the exchange rate along that particular line? So here we're looking at the reactions of traders and foreign exchange markets to changes in four key factors. Okay, there's relative price levels. Is the CPI growing faster in the United States than in Japan? If it is, then that's going to affect the exchange rate over time between the dollar and the yen. Relative productivity levels. Are workers in the United States becoming more or less productive than workers in Japan? That also will affect the exchange rate. Preferences for domestic or foreign goods. Okay. If suddenly investors in the consumers in the United States want to buy those automobiles from Japan because they're well known for their quality or what have you, then that's going to affect the exchange rate, as we'll see here in a minute. And then trade barriers like tariffs and quotas and so forth will have an effect on the exchange rate. So let's look at each of these factors. There's four factors there, and try to see if we can determine in particular how those factors will affect the dollar exchange rate, the dollar's exchange rate with respect to currencies from other countries. Maybe we talk about here, I think we'll see this in a graph. Here in figure 12.2, there's four graphs here. Each one of these corresponds to one of these four lines here in this chart. And I think here we're talking about the market for pounds. You'll see on the horizontal axis in each one of these, pardon me, we're measuring the quantity of British pounds. And so we're pricing the pounds on the vertical axis in dollars per pound. Okay, so this is the price of the pound. That's the exchange rate. For a British citizen, that would be an indirect exchange rate that would give the price of a pound in terms of quantities of pounds that we might measure on the horizontal axis. So you have four graphs here, basically like a price versus quantity framework that you have in your microeconomics principles courses. We're used to P on the vertical axis and quantity on the horizontal axis. It's just that on the vertical axis, the price is the price of the British currency, the pound, in terms of dollars. So it's dollars per pound, not dollars per gallon of gasoline, but dollars per pound. So you got price of a pound on the vertical axis. Quantities of pounds either demanded or supplied on the horizontal axis. So first off, we'll look at how the U.S. price level affects the exchange rate. Okay, so maybe the dollar price of a pound. So what if the U.S. price level is increasing, say in respect to or in comparison to the price level in the United Kingdom? If the price level in the U.S. is increasing rapidly in comparison with that of the United Kingdom, then U.S. consumers desire relatively low price UK goods, British goods. So if things are getting expensive in the United States, Americans are going to want to buy British goods. And so the demand for the pound would increase. And if the demand for the pound increases, that is, there is a rightward shift in the demand for the pound curve, then that would cause a depreciation here for the U.S. dollar and appreciation in the British pound. So we see that here, say, in this first diagram. I hope you can see that. Let me see if I can blow this up. But this first one is the result of increase in the price level in the United States. And two things are going to happen as a result of that. First off, American citizens are going to want more pounds. So there's a rightward shift in the demand for pounds because they want to buy British instead of American goods. American goods are getting too expensive. Then fewer British citizens want to buy American goods. So there are fewer pounds being supplied now on global Forex markets. Now, Forex is foreign exchange. It's the biggest market there is, the Forex market. So there are fewer pounds being supplied. Remember, this is the market for pounds. Fewer pounds are being supplied by British citizens to exchange for dollars to buy American goods. So British citizens want fewer American goods. American citizens want more British goods if, in fact, there's an increase in the price level in the United States. And so the net result is a depreciation of the dollar or an appreciation in the British pound. So you see here in this case with a rightward shift in the demand curve, leftward shift in the supply curve, that it takes now more dollars per pound to buy a pound. Took before these shifts took $1.50 to purchase a British pound. Now it takes $1.60. So the pound is more valuable with respect to the dollar. So we say in this case that the pound has appreciated. Equivalently, the dollar has depreciated. Conversely, if there's a decrease in the price level in the United States, that will cause an appreciation of the dollar, as there is a corresponding depreciation in the British pound. We could graph that out as well. You would have a leftward shift in this demand curve and a rightward shift in the supply curve, and this arrow would reverse. Let's see if you can think that through, but it's very analogous to what we did with a increase in the price level in the United States. How about productivity? What if there's an increase in productivity in one of these markets here, either in the UK or in the United States? I think your book talks about an increase in the productivity of citizens in the United States. Say productivity growth is greater because of technological innovation and so forth. It's occurring more rapidly in the United States than in the UK. If that's the case, then U.S. goods become relatively less expensive. Okay, and so British citizens want more U.S. goods, and U.S. citizens want less UK or British goods. Okay, because with productivity increases, in the United States greater than they are in Great Britain, then American goods are becoming relatively more affordable to both populations of people. So the effect on the dollar's exchange rate is that more people are going to want American goods, so there'll be an appreciation in the dollar, correspondingly a depreciation in the pound. We'll see that right here. Okay, so again, if Americans are becoming more productive than our British citizens, then there's a smaller demand for the British pound. So there's a leftward demand shift for pounds. And there's more, though, British citizens want to buy American goods. So they're supplying pounds on the Forex market. They're supplying pounds to get dollars because ultimately, if you're going to buy American goods, you got to pay for those goods in dollars. So they're supplying pounds, trading those in for dollars. So there's a rightward shift in the supply of pounds. There's a leftward shift in the demand for pounds, causing then a depreciation in the pound, right? The dollar price of a pound is going down. Conversely, if there were a decrease in productivity in the United States, that would lead to a depreciation in the dollar. We would again just simply reverse these movements that we noted here in the diagram in the upper right. See if you can think through that, okay? These movements are not difficult. There's nothing really esoteric here. It's just a matter of kind of reasoning things out just a little bit. Okay, how about preferences here? So suppose United States consumers have stronger preferences for U.S. goods. So there's an increase. I'm sorry, UK goods. This is the way your book wrote this. I might have would have done this one a little differently, but suppose there's an increase in the demand for UK goods, for British goods. Okay. Well, what would happen there? We would see in the lower left-hand corner here, there would be an increased demand for pounds. For some reason, people want to buy that British tea. I don't know what it is, or that Swiss chocolate, or whatever it is. There would be an increase in the demand for the currency that good is priced in. So British tea is priced in pounds. So there'd be a rightward shift in the demand curve here. And so the dollar value of a pound would increase. That is to say, the pound would appreciate or the dollar would depreciate. So we have here depreciation here. This is the effect on the dollar's exchange rate. The dollar would depreciate. Conversely, if anything would cause a decrease in the preferences for British goods, say, that would for UK goods, that would cause an appreciation in the dollar and a corresponding depreciation in the British pound. Again, just think these through. Make sure you get this at the gut level. Make sure you build your intuition in thinking these things through. That's what I care about in this course. Not that you memorize a lot of things, but that you internalize this information. And so these should become commonsensical to you if you think about them enough. Always remember that the goods and services that emanate or originate from a particular country are going to be priced in that country's currency. And so if you want citizens of the world want more of the goods and services coming out of that country, that's going to cause forces that will result in an appreciation of that currency, that country's currency, and a corresponding depreciation in the currency of consumers around the world who want more of that British tea or whatever it is. Trade barriers, okay, is another one we can look at here. Suppose, for instance, the United States government imposes tariffs on British steel, okay? So there's an increase in trade barriers here. That would discourage Americans from purchasing British steel. And so the demand for the pound, the British pound, would diminish, and there would be an appreciation in the dollar. So you see here this leftward shift in the demand for pounds is going to exist, causing a corresponding depreciation in the pound. It takes fewer dollars now to buy a pound. It takes now only $1.45, whereas before it took $1.50. And we could equivalently say that that is an appreciation here in the dollar. Okay. Depreciation in the pound is an appreciation in the dollar. So make sure you think that one through as well. Okay. All right. So now we go to inflation rates, purchasing power parity, and long run exchange rates. We're going to see here that we have a theory called purchasing power parity that will establish an implied exchange rate for good between currencies that may depart for a while between the exchange rate that's recognized on foreign exchange markets. So the law of one price is a very simple idea. It says that identical goods should be sold everywhere at the same price when converted to a common currency, say dollars. Okay. Now, because we'll put the assumptions here in a minute, but we're going to look first at a Big Mac, okay, at McDonald's. What the nice thing about a Big Mac is it's pretty much the same good regardless of where you buy it in the world. If you buy it in Switzerland or if you buy it in Japan, Tokyo, or Beijing, or the United States, Big Mac is so much beef and lettuce, bacon, lettuce, cheese, tomatoes on a sesame seed bun or something like that. Okay, there used to be a jingle in that respect. Now, so that should sell for the same price, regardless of where you buy it around the world. If you take the price and convert it into dollars, okay. But that would assume then that it's costless to ship goods between nations. So first off, we recognize that a Big Mac has ingredients that may come from various places in the world. It may have Argentine beef, it may have tomatoes from California, and some of the sauce may come from Italy or what have you. So the idea is that it costs money to ship those goods, and then once you put the Big Mac together, you don't really ship Big Macs around the world, but other goods you do. You may construct something else, electronic part or something like that, and then ship it. Big Macs don't have a very long shelf life, so we don't really export and import Big Macs, but we do export and import the goods or ingredients we use to make Big Macs from. So we're going to assume, first off, it's costless. There's no cost involved in shipping the final good or the ingredients between nations. There are no barriers to trade, okay, no tariffs, no quotas, and so forth. The markets are competitive, okay. The beef market, say, is very competitive, and people who purchase beef, say McDonald's, they have to pay the price that's prevailing in the beef market. Okay, they're not so big that they can drive down the price of beef and so forth. So we have competitive resource markets and so forth. So at any rate, there's kind of like three types of assumptions here that have to be in place for the law of one price to hold. The law rests on the assumptions that sellers will seek out the highest possible prices and buyers will seek out the lowest possible prices whenever they buy or sell goods. Okay, so we'll see that in just a minute in something called the arbitrage opportunity. There can be no opportunity for arbitrage. That is to say, arbitrage will occur. It's a riskless opportunity to earn a profit. If you can buy beef in one country at a real cheap price and turn around and sell it in another country at a very high price, and there's no cost associated with shipping and so forth, that's called an arbitrage opportunity. If you can do that all day long, buy low, sell high, just by moving the commodity from one place to another, we're going to assume that can't happen, okay? Because sellers will always seek out the highest possible prices and buyers the lowest possible prices. So if there is an arbitrage opportunity, it will quickly disappear because the buyers seeking out lower prices will go buy beef where it's cheap and thus drive up the price. and they'll go sell it where the price is high and drive down the price in that country. So sellers drive down the price, buyers drive up the price. And so if that happens, then arbitrage opportunities dissipate very quickly over time. And that has to be a condition in place for the law of one price to prevail. Also, any differences in exchange rates are limited by this arbitrage opportunity. Okay, so that is to say, there's no arbitrage. Arbitrage may exist for a little bit, but that is the opportunity to simultaneously buy low and sell high, as we talked about just a moment ago. Well, that opportunity will dissipate because sellers will always seek out the highest possible price to sell their goods, and they'll go buy wherever they can get their goods at the lowest price. So no arbitrage opportunities. I guess we could basically put these two together by saying that. Also, a little more here on explaining what arbitrage is. In this slide, I kind of inserted this here just to give you an example of what arbitrage is. And again, we're going to assume that if there are arbitrage opportunities, those dissipate really quickly. But here's an example of an arbitrage situation. Assume that a particular piece of furniture is cheaper than the same item priced in, say, in the U.S. after converting Swiss francs into dollars. So a Swiss importer could realize a profit by purchasing the item in Switzerland, say if it's real cheap in Switzerland. Let's just say in Switzerland here. Make this, I think I probably intended to do that. So it's cheaper in Switzerland than it is in the United States, a chair. After you convert it to dollars in Switzerland, and heck, it takes fewer dollars to get the chair. Buy it in Switzerland, you can sell it for more in the U.S. Swiss exporters would realize a profit then by purchasing the chairs in Switzerland and at a low price and selling them in the United States at a high price. There'd be a profit there on the table if really there were no costs associated with shipping the item and so forth. This transaction, though, would force up the item's price in Switzerland and down in the United States until the price of the item eventually becomes equal in both nations. So again, what we're saying here with these two slides here is that the law of one price is a natural result from a situation where there is no arbitrage opportunities, or if there are, then the opportunities go away really quickly as exporters and importers, buyers and sellers of the goods respond. They buy immediately where they can find the good cheap and sell it where they can sell it at a high price. The law of one price holds reasonably well for globally traded commodities such as oil, metal, chemicals, and other agricultural crops. You think about aluminum, for the most part, aluminum is aluminum, okay? And just because it originates in one country doesn't necessarily mean it's superior to aluminum in another country. So the law of one price holds pretty well there. The law of one price, though, does not hold well for non-traded goods, okay, and services such as cab rides, housing, and haircuts. It may be the case that a haircut is much cheaper in the United States than it is in France. But a French citizen is not apt to hop on an airplane and go to the United States every time they need a haircut. And you certainly can't move haircuts from one place to the other. Would not be, you might be able to move hairdressers, but you can't move haircuts. So at any rate, where goods are non-traded, the law of one price does not apply. Cab rides, okay, and housing, so forth. The law of one price does not apply. So the law of one price really doesn't hold for any kind of goods that are insulated from global competition, and when there is significant shipping costs and tariffs, the law of one price would not hold. So let's look at burgernomics here, okay? Using the law of one price to imply or infer an exchange rate between currencies. And we're going to use the Big Mac to do that. So we're going to assume that the law of one price would say that a Big Mac should have the same dollar price anywhere in the world. Whatever the domestic currency is, if you were to convert that to dollars, then that Big Mac should have the same price anywhere in the world. Okay. Of course, again, these assumptions we've made don't really hold 100%. There are shipping costs, there are tariffs, and so forth. If you got a tariff on beef in one country, if we have a tariff in the United States on beef coming in from some country, then of course that's going to affect the law of one price, the price of a Big Mac, which is significant, has a significant amount of beef in it, and so forth. So what we're going to do is attempt to measure the true equilibrium value of a currency based on one product, the Big Mac. Big Mac is an ideal good, I guess you'd say, because it has lots of imported ingredients. It's kind of a, if you'd say, you might say that the Big Mac is kind of a product of the world a little bit. Okay. So constructing an implied exchange rate based on the assumption that a Big Mac should cost the same in different countries is what we're going to do here. It can be used to determine the extent to which market exchange rates differ from this true equilibrium exchange rate that we'll recognize from the law of one price. We'll see that Big Mac prices show the law of one price does not hold across countries. It theoretically should, but it doesn't. Okay, so there's a departure, that is to say, between the implied exchange rate from purchasing power parity and the market exchange rate. Say, for instance, for the Swiss franc, if you price a Big Mac in Switzerland, if you want to buy a Big Mac in Switzerland, here on July the 10th, 2019, it costs 6.5 francs. On that same day in the United States, a Big Mac on average cost $5.74. So if you take the first value and divide it by the second value, you get an implied exchange rate between the franc and the dollar. Okay, so that would be 1.13 francs will remain on top and dollars on the bottom. Francs per dollar. Okay, but on that same day, the Forex markets, if you looked in the Wall Street Journal, what have you, or if you looked at CNBC, or Fox Business Network, or so forth, if you tracked exchange rates on that very day, you would have seen that that took 0.99 Swiss francs to purchase a dollar. So there's a disparity here between these two rates. Relative to the market exchange rate, the rate implied by the law of one price, which the law of one price would have the franc basically undervalued here. The franc is undervalued. The dollar would be overvalued. At least, this value right here has the franc cheaper with respect to the dollar than it is here. It takes a lot more francs to buy a dollar here at that rate than it does here. So you have a percentage of undervaluation of the franc. Okay, that's implied by the law of one price by 14.1%. All you do is you take the difference between these two, take the difference between those two, and then you divide that difference by this value right here, you get 14%. So there is an undervaluation of the franc over here relative to what the market would suggest on that same day. Okay, so the law of one price would say that franc is not really worth as much as currency markets that day recognize the franc to be. Okay, so there is an undervaluation here of the franc. If you looked at purchasing, or if you looked at the law of one price, this number, it takes more francs to buy a dollar here than here, so there's an undervaluation of the franc. Over here for the Swedish kroner, kind of have the opposite here. We see that there's an implied exchange rate by the law of one price of 8.89 kroner per dollar. Why is that? Because the Big Mac on July the 10th, 2019 cost 51 kroner. Again, in the U.S., you see all these are the same number here. It's $5.74 per Big Mac. So take the first number and divide by the second number. You'll get 8.89 kroner per dollar. But the Forex market on that day was pricing the dollar or the kroner at 9.48 kroner per dollar. So again, now here you got a different situation here, that the rate implied by the law of one price suggests that the kroner is a little stronger than it really was on currency markets of that day. And if you look at, it just depends on which way you compare this, but this is a stronger kroner than you have here. It takes fewer kroners to equal a dollar if you use the implied exchange rate, the rate implied by the law of one price. And so we have a 6.2% difference here between these two rates. That's the main thing I care about here, that you can compute the absolute value of these things by taking the difference in these two and dividing by the market exchange rate on that day. Okay, so you should be able to complete this table out here. And you see when you're done, whether you're looking at the Swiss franc, the Swedish kroner, the British pound, the Japanese yen, the Mexican peso, that the Big Mac index will suggest an exchange rate here on the left that is a little different than what was actually recognized in currency markets on that day for a variety of reasons. But one main reason is that these assumptions that we're making that underpin the law of one price don't hold absolutely. For instance, there are, again, significant shipping costs and tariffs and so forth when you start trying to apply the law of one price. You can also do this with steel. What we did with the Big Mac, you could do with a ton of steel. Here's just an example here. It says, according to the law of one price, if the yen price of steel increases by 10%, the yen price of steel increases by 10%. So you might have a situation like this here, where on one day it takes 50,000 yen. So a yen's not very big. Okay, it only takes, you see here, it's two orders of magnitude different than the dollar, but it takes 50,000 yen to buy a ton of steel one day, and maybe a year later it takes 55,000 yen to buy a ton. That would be a 10% increase in the price of steel in yen, say in Japan. Okay, and the dollar price though of steel remains constant. So steel has not gotten any more expensive in the United States. Kind of roughly speaking, this as far as American citizens who pay for steel in dollars say, hey, the price of steel hasn't changed. But if you were in Japan buying a ton of steel, say, hey, there's been a 10% increase. Okay, well, what would be the result then? Okay, well, the exchange rate implied by the law of one price in the first instance would be 100. You just take the first number, Big Mac, well, it's not going to let me take this number here and divide by the second one. You get 100, and then in a year later, what have you, get 110. That would be the exchange rate movement, yen per dollar. So now it takes 110 yen to equal a dollar after a year has elapsed, when there's been inflation in Japan, but not in the United States. Now, this already suggests something we're going to see in what's called purchasing power parity here in a minute. You see that kind of roughly speaking here is that where you have, in countries where you have higher rate of inflation, okay, so there's kind of some inflation here, if you will. I know we're only looking at one commodity. We're not looking at a basket of commodities that underlie the consumer price index or something like that. But the same idea applies. You have an increase in prices in Japan over time, but not in the United States. What that means is then that the the country that's experiencing the inflation or the higher inflation is going to see its currency depreciate. Okay, so the yen depreciates with respect to the dollar because there's inflation in Japan. Okay. Okay, so this leads us to this theory called purchasing power parity that's based upon the law of one price. It's a theory that exchange rates adjust to make goods and services cost the same everywhere. So exchange rates will adjust over time to satisfy the law of one price. So purchasing power parity, and some of this, by the way, I've highlighted some things that I added to the slides that were provided to the publisher. So you might want to just make a note of that. Okay, but application of the law of one price here is that purchasing power parity is simply the application of the law of one price to national price levels. So instead of a ton of steel, just looking at a ton of steel, we might look at the basket, say, that undergirds or establishes, say, the consumer price index. Of course, that raises an issue there as well, because the CPI is not the only price index we could apply to, we could appeal to here when we start trying to look at movements in the exchange rates. But for the moment, let's think about this consumer price index has 100 or so items in the basket. So we don't just use a ton of steel, might have a portion of steel in there, but it represents a typical basket of goods that a consumer would purchase in a year. So it had some gasoline in there. I mean, if core CPI wouldn't, but we take out the gasoline. But that is to say, there's certain items, beef and food and even movie tickets and so forth that are in the consumer price index basket, the CPI basket. So we're going to apply the same theory here just to a basket of goods. So we'll note that we're going to apply the law of one price to a basket of goods. Changes in relative national price levels will then determine changes in the exchange rate over time, just as we noted it in the right-hand column, a change in the exchange rate here because the price of steel changed differently in Japan over time than it did in the United States. If the rate of inflation is much higher in one country, then its currency depreciates relative to others. Again, we saw that here, kind of the same logic we saw here. If that's true, then money has lost its purchasing power over domestic goods. Currency should depreciate to restore parity with prices of goods abroad. So the thing is, you're always going to be trying to adjust to the law of one price. If you have inflation that occurs in one country but not in another, then then the exchange rates have to adjust so that at some point, say after a year's time, then if you take that basket of goods and price them in a common currency, you should get the same price. So exchange rates will move in such a way to offset differentials in inflation rates between countries. Okay, exchange rates will move in such a way to offset differentials in inflation rates over time. That is the law of purchasing power parity. And you're going to see this formula here. Let's skip down to it here. On at the bottom here. This is in your text in chapter 12. What you have here is the dollar price of the Swiss franc, say. I've got here pound. It could be the pound or the Swiss franc. I think your book uses the Swiss franc. That's why they have S in the denominator. So I'll just put that right here. So suppose S of 0 is the initial equilibrium exchange rate in some base period. Maybe this is the year. Let's use nice round numbers. So this is the year 2020 here, okay? S of 0. So there is so many dollars per Swiss franc. Maybe maybe it's $0.95 equals 1 Swiss franc, whatever that is. Okay, well, that value is going to change over time so that after 1 year, to be at the end of the next year, so we go from 2020 to 2021, it's going to change according to this formula. So what do we mean here? Well, what you have is a multiplier here. The initial exchange rate is multiplied by this fraction. This fraction has fractions in the numerator and denominator. So it's a complex fraction, okay? And it's not complicated. It's called a complex fraction, but it's not complicated if you think about what this fraction represents. First off, P is price level. So it's like the consumer price index or something like this. This is the price level at period one in the United States. It's the price of a basket of goods, common basket of goods. What is the price of that, the CPI basket after that year compared to the price of that basket at the end of the previous year? Okay, so what you have here is an inflation rate, right? That's all this is. It's the rate of inflation. We don't really experience deflation much in the United States, but the normal state of affairs is if you have a basket of goods, we all know this from shopping at Walmart, it costs more next year to buy the same basket than it did the previous year. So typically speaking, when you have inflation, this is a fraction greater than one. The numerator here is a fraction greater than one. It represents the price level at the end of the period compared to the price level or the price of that consumer basket at the beginning of the year going to be greater than one when you have inflation. So if a basket at the beginning or at the end of the previous year cost $100 and then it cost $120 at the end of the next year, then there was 20% inflation. This would be 1.2, but that fraction would represent a 20% inflationary change in prices in the U.S. Correspondingly, you have the same measurement in the denominator, say for Switzerland. That's why we use an S here. So this represents the rate of change in prices in Switzerland in the denominator. This is the rate of change in prices in the United States. If there's more inflation, greater inflation in the United States than in Switzerland, then this complex fraction is greater than one. And so that's going to push up the equilibrium exchange rate. It's going to take more dollars to equal a Swiss franc at the end of period one than it does at the end of period zero. Okay, so over time, S, okay, this variable we're measuring here, that's going to increase over time if there is more inflation in the United States, greater inflation than there is in Switzerland. So that this complex fraction has a value greater than one. I hope that's intuitively appealing. This is purchasing power parity. It's based upon the law of one price. Okay, and it says that at the end of the period, that it should be the case that if we convert that basket of goods to a common currency, say dollars, you should still have one price prevailing. So what happens then is that there has to be an adjustment in S, okay, and the exchange rate to offset a differential in the inflation rates between the two countries. Okay, so if there's more inflation in the U.S. than in Switzerland, capital S is going to grow. Okay, it's going to take more dollars to equal a Swiss franc at the end of the second period or after the end of the period of time. If there's more inflation in Switzerland, then this complex fraction has a value less than one, something between 0 and 1. And so we would see that S1 would be less than S sub 0, and in which case the dollar would be appreciating. Okay, so if there's more inflation in the U.S., the dollar's depreciating. It takes more dollars to equal a Swiss franc. If there's more inflation in Switzerland, the dollar's appreciating with respect to the Swiss franc. And so S here would be falling in value. Okay, it takes fewer dollars to equal Swiss franc when there's inflation in Switzerland. Now, so there are limitations, though, on the purchasing power parity theory. The exchange rate movements may be influenced by investment flows as well as these prices in largely consumer goods. We've been talking about the price level. The price level is what's pushing exchange rates under purchasing power parity. There's nothing in this formula that deals with currency flows due to investment. Okay, people may want to invest in Swiss bonds instead of U.S. bonds because there's a differential in real interest rates and so forth. there's nothing, at least directly, in this formula that appeals or refers to uh, any real interest rate differentials. Okay, so this is a limitation of purchasing power parity. Obviously, if suddenly people want to buy bonds in Switzerland as opposed to bonds denominated in US dollars, that's going to, you would think, at any rate, have an effect on the exchange rate. I mean, people want to buy or want to trade in their dollars to get Swiss francs so that they can buy Swiss government bonds. And that would cause the Swiss franc to appreciate relative to the dollar. There's nothing in this formula about this. But we will see in another theory here in just a minute, kind of that is an alternative to purchasing power parity. That we can look at those things. Other limitations purchasing power parity is that government policy may get in the way through trade restrictions that would disrupt the flow of exports and imports. Purchasing power parity does better at forecasting exchange rates appropriate in the long run, but it's a poor forecaster in the short run. Remember this, so that's slide 24. So let's go back here just a second. This diagram we looked at previously, way back up here. And what it said is that, you know, there are theories that kind of determine the direction of the blue arrow. That's a long run path in purchasing or in exchange rates. And the purchasing power parity does a pretty good job in explaining this blue arrow. But then there are aberrations around that, in particular, this thing right here. But the cyclical natures as well. But these things are more explained by other theories than by purchasing power parity. Okay, that's what they're saying here in 24. Again, the purchasing power parity does a good job at forecasting the slope of that long blue arrow, but a poor job in explaining why there are these cyclical movements about trend. Now, here's a case in particular. Okay, now see, purchasing power parity, if we go back to this formula first off, says that where you have relatively high inflation, you should have a depreciation of that country's currency. And you kind of see that here when you talk about the United Kingdom and the U.S. Here we have purchasing power parity between the United States and the United Kingdom from 1973 to 2011. You got an index here. Basically, it says that with this blue graph right here, we're taking the UK inflation rate and dividing by the US inflation rate. And since it's sloping upward over time between 1973 and 2010, that's suggesting that kind of over this period of time, there's a little more inflation in Great Britain than there is in the U.S. Okay, that's why it would slope downward if there were more inflation in the U.S. But the way this fraction is constructed, the numerator is larger than the denominator over time. There's more inflation in Great Britain than there is in the U.S. That's why this is sloping upward. And so in this index here, basically as a ratio, you have a base year where you're starting out at the same, but from that point onward, it seems that, the pound is depreciating with respect to the dollar over time. At least that's what would be predicted by purchasing power parity, because again, the exchange rates are determined by the relative inflation rates. And so the country here that's experiencing more inflation should see its currency depreciating. So you see this arrow's pointing up. Pound depreciation occurs when a time series goes up. And in fact, what you see is some correlation here. You see that often whenever the blue curve is going up, the red curve also is going up. And what is this? The red curve is the exchange rate itself that can be observed in the Forex markets on a day-to-day basis here. the exchange rate between the pound and the dollar. It takes more pounds to equal a dollar, say in this region right here, because again, there's more inflation in the UK than there is in the US. But then there are some departures here. Okay, this is kind of interesting here. This departure and so forth. And your book talks about why, in certain instances, there will be a departure between these two. In particular, I think they focus on uh, uh, I think near the end of the 20th century, in this case right here. I don't know why they don't spend a little time with an explanation here. I kind of know what was going on with monetary policy in the 1980s with Paul Volcker at the head of the Federal Reserve, but we won't get into that. But what we have here is this line suggests that uh, uh, the pound should be depreciating here, when in fact this line right here kind of suggests that it's the dollar that's depreciating. But then it turns back up in here. At any rate, I'll just say that some of these aberrations, and you see it again here, has to do with the fact that investors are looking more at simply a differential in inflation rates between the two countries. Sometimes, uh, uh, say, British citizens want dollars to invest in U.S. companies, and it has nothing to do with there being more inflation in one country than the other. There are other factors that enter the picture than simply differentials in the inflation rate. So all that's to say is that kind of, if you stand back from this picture a little bit, there's kind of a general movement in the same direction with the exchange rate and the ratio of the inflation rates. But of course, when you get up closer, there's departures. These two curves do depart. PPP would suggest that they would move together, but there's departures from purchasing power parity for other reasons. And you might read that in your text just a little bit. Sometimes banks get in the way and they start manipulating foreign exchange. There's a discussion in your book on that. You might think about this question: do you think penalties should be placed on banks that rig the foreign exchange market? Another way of stealing, really, in my opinion. Okay, now here we're going to look at another theory here, the asset market approach. This is an alternative, if you will, to the purchasing power parity approach. Again, remember back here, let me go back to a previous slide. I think it was this one right here. We've been talking about the long run with purchasing power parity. And PPP kind of, through these things, especially inflation rates, establishes trends in the long run rate, the long run movements of the exchange rates. Now we're going to look at the short run here. And the short run, there can be these aberrations from the long run rate because of differences that arise in real interest rates. Okay, real interest rates. So again, just kind of roughly describe what a real interest rate is. If a treasury bond will pay you 5% a year, so you take $1,000 down, you expect $50, or a corporate bond, you expect a $50 coupon payment or return. There's a couple different returns, but $50 on $1,000 would be 5%. You expect a $50 return on a $1,000 investment for the year. That'd be 5%. But what if inflation's 3%? Then the real rate's only 2%. You have to subtract out the inflation rate from the nominal rate to get the real rate. Okay, and it's the real rate that it attracts investment. So investors aren't stupid. They're going to look at the nominal or stated rate that bonds say will pay, and they will adjust those by inflationary expectations, what they expect the inflation to be going forward. And so they arrive at the real rate. So when we talk about what's called the market, the asset market approach, we're going to look at how real interest rates affect the exchange rates, and whether people want to buy or want to obtain pounds to buy British bonds, or they want to obtain dollars to obtain and purchase dollar-denominated financial assets, like not only dollar-denominated bonds, treasury bonds, and so forth, but stocks and so forth. So you have, in fact, all asset classes. We think primarily here in this theory here of the asset market approaches applying to assets like treasury securities, corporate bonds, and stocks and so forth. Those are called financial assets, but also real assets as well. Anything that, generally speaking, if you buy property in the United States, you're going to pay for it in dollars. Okay. And so if there's some reason why British citizens want to buy property, real property in the US, they want dollars. They'll supply pounds in the Forex markets to get dollars, and then they'll take those dollars and they'll buy that building. So I just think these things through, if you will. And the asset market approach, though, it's a little different way of trying to capture movements in the exchange rate, say between the dollar and the British pound, by looking at the attractiveness of assets between the two countries. And that's measured in what's called the real rate of return, or the real interest rate. So you have to keep inflation in mind. Okay, we can't forget what was a factor in purchasing power parity here. This complex fraction here that involves inflation rates, the ratio of inflation rates. That also is a part of this this asset market approach. But here, though, we're not necessarily looking at pricing basket of goods and so forth, and how currencies will flow in as they chase basket of goods. In this case, we're chasing assets. Investors have to decide between domestic and foreign investments based upon two things primarily. First off, the relative levels of, could put here, nominal interest rates first. Those are the stated rates. Then we adjust those with inflation through what's called the Fisher equation. The Fisher equation is simply, I wonder if I could write that here. Let's see here. Let me just say that the Fisher equation basically says that the real interest rate is equal to the nominal rate. And this is not exact, okay? Actually, there's an interaction term here, and it's neither here nor now, but the nominal rate. So if you have, the bank says they're going to pay you 6% on $1,000 invested with them in some sort of security, 6%. Well, that's fine. That's called the nominal rate. Then you need to subtract from that expected inflation the next year. So if you expect inflation to be 2% next year, then that 6% should be adjusted by that 2%. So your real interest rate would only be 4%. Okay. So 6% here, subtract 2% here, it would give you a 4%. So investors are going to calculate the real interest rate on investments in different countries. And the capital is going to chase those investments that pay the highest real interest rate. So you look at expected changes in the exchange rate itself over the term of the investment. Okay. So how long are you going to be in that investment? You may be restricted to being in the investment for more than a year, so forth. So there's different kinds of investments. So how would this work? Okay. Well, again, we're looking at the asset market approach. And so first off, there's the U.S. interest rate. As that increases, investors are going to turn more and more toward dollar-denominated assets. As they do, they want dollars to purchase those assets, so the dollar would appreciate. If the U.S. interest rate decreases, okay, so corporate bonds are paying a lower coupon rate and so forth, then say American investors and UK investors are going to be more inclined to buy, say, UK denominated or pound denominated bonds and stocks and so forth. And so that would depreciate the dollar. Okay, there would be a depreciation on the dollar's exchange rate. That's technically, we just say that the dollar depreciates. That would have negative effect on the exchange rate, but the dollar is depreciating with respect to the pound. You got all these different currencies that move in different directions with respect. One currency could say the dollar could appreciate with respect to the pound, but depreciate with respect to the Mexican peso and so forth. So there's lots of different comparisons that can be made. So the British interest rate, what if the British interest rate increases? Investors are going to want pound denominated assets. The effect on the dollar is that people don't want dollars. They want pounds so that they can buy British assets because the interest rate's higher there. So the dollar will depreciate and so forth. Hope this makes sense. And down here, we're at the bottom, we're at expectations of future exchange rate movement. So if you expect the dollar to appreciate, then go ahead and buy dollars today. Cash in those, turn those pounds into dollars. That is to say, if you think the dollar is going to get stronger, it's going to be worth more pounds in the future, get ahead of that. Now, everybody's going to do that. If there's an expectation of something rising in value in the future, people will buy it today. That's just common sense, right? You think the price of land is going to go up markedly in the next few years, go out and buy some land today before the price actually does go up. That'll drive up today's price. Okay, today's price is largely driven by expectations of where prices are going to be in the future. So the level of nominal interest rate is a first approximation of the rate of return on assets that can be earned in a particular country, but that's called the nominal interest rates, and we have to adjust those by inflationary expectations so that investors will always seek the highest real rate of return, really, and that's determined down here. The real interest rate is the nominal rate minus the inflationary rate. So again, we're kind of repeating ourselves here, but that's what investors really care about. So if interest rates rise in the U.S. or they're greater than interest rates abroad, expect there to be an increase in demand for dollars or an appreciation in the dollar. If interest rates in the U.S. Are lower than abroad, then there'll be a decreased demand for dollars and corresponding dollar depreciation. So we have this graph here, factors affecting the dollar's exchange rate in the short run. Again, this asset market approach is it explains short run fluctuations. It's more toward explaining the short run of fluctuations than long run. The purchasing power parity applies to long run forecasting. Asset market approach, because investors always have short time horizons, right? I mean, that's just the way we are. We have a lot of people who invest not simply to sit on the board of directors of anything or to hold. Most people trade stocks and bonds like trading cards, okay? So they're in and out in quick periods of time. So you talk about the short run here when you're talking about investor behavior today in any kind of market, be it equities market, stock markets, or the bond market, and so forth. So we have two different situations here, two different types of factors now that affect the dollar's exchange rate in the short run. Two different types. The first here is pictured in the first paragraph. I couldn't split these apart. The first diagram. Okay, this compound diagram is in your text. You might want to look at it a little closer in your book. So we're going to focus on this first one. This is figure 12.4. We look here at factors affecting the dollar's exchange rate in the short run through relative interest rates. Okay, so here's just a hypothetical. Suppose there's an expansionary monetary policy in the U.S. Again, I said this earlier, but short-term movements like overshooting and so forth, especially and exchange rates, we'll talk a little more detail about that in a minute, but can be the result of a sudden announcement by policymakers, be it the Federal Reserve or the President, Congress, respecting, in the case of the Federal Reserve, monetary policy, or with respect to the government, it could be tax policy or some other fiscal policy. Just sudden things in the news, okay, will push investors one way or the other. So the linkage here is news items, current events, work through the asset market approach here to push exchange rates in the short run, one way or the other. So in this case, maybe the Federal Reserve announces a plan toward expansionary monetary policy. That is to print a bunch of money going forward for a period of time. Well, that will result in a fall in U.S. interest rates. Okay. So interest rates, you should know from your previous courses there, this kind of this inverse relationship here. When you have expansionary monetary policy, you're lowering the interest rates. The Federal Reserve has more power over the short end of the yield curve than the longer end, but the idea is through the federal funds rate and so forth, expansionary monetary policy tries to get the economy going by lowering those rates. It's easier to borrow money, and so it's easier, say, for consumers to go out and buy. So if that's the case, then Americans will want pounds and Brits will not want dollars. Say if we're comparing what's going on in the market for pounds, that is comparing what's going on between two classes of investors in the British currency, Americans and Brits. So first off, again, the Fed in the United States says we're going to print a bunch of money, we're going to lower interest rates. Boom. Two things are going to happen. Okay. Americans are going to want pounds. They're going to want to get out of dollars and get pounds because the dollars are going to they're going to lose value. And correspondingly, so there'll be a rightward shift in the demand for pounds, but there'll be a leftward shift in the supply of pounds because holders of pounds, British citizens, are no longer going to supply pounds to the foreign exchange markets to purchase dollars to buy American goods, okay, and so forth. They don't want dollars. They want, because dollars are going to lose value because the Federal Reserve said they're going to expand the money supply. So you got a rightward shift in the demand for pounds, a leftward shift in the supply of pounds. So the equilibrium point, which is the price of a pound, dollars per pound, is going to go up. So my question here is, which currency appreciated, which currency depreciated? So the pound appreciated and the dollar depreciated. Okay. Second picture here. Here's working through expected change in the exchange rate. So now we have expectations of what the exchange rate is going to be in the future. UK investors expect the dollar to appreciate relative to the pound. Then Brits will go ahead and exchange pounds for dollars. Okay. If you think dollars are going to get more expensive or relative to the pound, go ahead and get those dollars and get ahead of that. And so what's going to happen here? Well, you're going to have an increase in the supply of pounds. Okay, British citizens are dumping those pounds. They want dollars. So as far as the market for pounds go, there'll be it'll take fewer dollars down to buy a pound after the rightward shift in supply, after the increase in supply. So the pound has depreciated, the dollar has appreciated. So at any rate, these are things that you should know. I would want you to know kind of at the intuitive level here, and so forth, that are pictured in these diagrams. That's a neat thing about economics in general, is that we can picture what's going on in diagrams like this, and the very simple supply and demand framework. Okay, so this leads to this thing right here, is that figure 12.5, for international investors, it's the relative changes in the real interest rate that really matter. Okay, the key word here is real. Investors are attracted by the real interest rate. Okay, only if higher nominal rates in the U.S. signal an increase in the real interest rate will the dollar appreciate. So we have a couple time series graphs here from 1974 to 2006. Notice we plot in the blue curve the real interest rate, which again is the nominal interest rate minus the inflationary rate. Notice how the dollar's exchange value tracks that pretty well. There's a little bit of a lag, maybe a recognition lag. This peak here is a little behind this peak. This trough here is a little behind this trough. This peak here is a little behind this one. So the red curve is tracking the blue curve, but it's offset by just a little bit for the most part. And so we see that when the real interest rate goes up, the dollar appreciates. See this arrow here on the right, which is the trade weighted value of the dollar. The value of the dollar goes up when the real interest rate in the United States goes up. And the dollar's exchange value goes down when the real interest rate in the United States goes down. So, I mean, you see here that there's a lot of explanatory power here in interest rates that can be derived, or exchange rates that can be derived from looking at real interest rate differentials. Okay, another picture of this, I guess. They talk about the linkage here and words. I think we've pretty much covered that here. Other things that might affect the desire of one currency over another, and thus the exchange rate is the relative level of interest rates is part of that, but other factors, the size of stock of assets denominated in a particular currency, an investor portfolio may want to include. In other words, if you have the idea, if you're an investor and you have too much of your portfolio denominated in British pounds, then you may be seeking simply to diversify into another currency, say in dollar-denominated assets. So, I mean, that if for some period of time everybody's been investing in Great Britain, then it's like putting too many eggs in one basket. There's a need to diversify there because the pound could crash. In fact, it has. In fact, a notable robber baron of our age caused the British pound to crash, and he got fabulously wealthy. Does anybody know who that is? His name is George Soros. Okay, he shorted the British pound back there in the 1980s, I believe, and he got fabulously wealthy overnight. Well, he was already wealthy, but he got much wealthier by basically he was able to short the pound and push the value of the pound downward, and he made a lot of money on that. But anyway, that's a different. So, but you don't want to be heavily invested in pounds if the British pound decides to turn south. So you want to diversify as you do in any asset or any investment strategy. Also, the U.S. is kind of a safe haven for a lot of investment. It draws investment because of its stable government, its steady economic growth, and its large, efficient markets. Okay, so there's a case study in your book that talks about how, well, I'll just say for the moment, how the World Bank, the International Monetary Fund, and the Central Intelligence Agency use purchasing power parity as the go-to method for comparing gross domestic products between countries. Okay, it's not perfect, but purchasing power parity seems to be the best explanation in making GDP comparisons across countries. And I'll just have you read that. I think if you read that paragraph in your text, you should be fine. Forget what page that is. I think that's on in the 18th edition on page 365. So the rest of this, forecasting foreign exchange rates, can be very tricky. Obviously, there are different tools. Let me say that sometimes we use their judgment as more subjective and common sense. But we also use two more formal methods of analysis, if you will. There's technical analysis. This is where you use charts and so forth. So look at certain patterns in the charts, and you think that history is going to repeat itself. So perhaps you've seen this sort of thing. There's different patterns we might see in a look back period over any time series. Here we're talking about dollars per yen, so the price of yen in dollars. And you may think some part of this typically repeats itself. So if you have two spikes followed by a trough, like you have right here, then if you see another two spikes, you may expect a trough. Okay, all right. I'm just saying that you're using patterns that you think are repetitious going forward. Uh, then you're in the realm of what's called technical analysis. Uh, Technical analysts sometimes are called chartists. They look a lot at charts and so forth. Um, I'll just say it ignores the economic fundamentals like price levels and productivity and those other things we were talking about. It's simply looking at charts to predict where the trend is going to go in the future. So, when you do that with stock prices or any other price, the price of yen and dollars, you're engaging what's called technical analysis. I'll just leave it at that. It kind of flies in the face of efficient markets. But then there's fundamental analysis. It's the opposite of technical analysis. It considers these economic variables that we talked about that affect the supply and demand of a currency. So things like, again, interest rates, balance of trade, productivity, inflation rates. Okay. Those are things that, especially in purchasing power parity, but also asset market theory too, those are things that we considered as determinants of exchange rate. So this is called fundamental analysis. So you have technical analysis and you have fundamental analysis. And sometimes we build econometric models about these things. I just mentioned this here. Most econometric models will use a combination of fundamental and technical analysis and also judgmental factors here. So this is where economics gets very technical, mathematical, just making mention of it here. For our class and for our purposes, we won't be doing any econometrics. But I just want you to know what the term is and so forth. It's using statistical methods on previous movements, so that would be using technical analysis, and on using other contemporaneous factors, that would be fundamental analysis, and judgmental analysis to predict where exchange rates are going to go in the future. Okay, so this last little thing here, sometimes you can have a misalignment between the exchange rates and fundamental values of the exchange rate that can be parsed out of the economy. And, that can give investors advantages. If they pick these things up, they can suspect that things will converge in the future. If the fundamentals say that the exchange rate should be different than what it is between two currencies, then investors can get ahead of that and make money. That's nothing really specific there that you'll need to know for the exam and so forth. I would want you to know, though, kind of scrolling back through this again, going to the outline here. These things, these first 4 points in particular, there's a lot here we talked about that I would want you to have an intuitive feel for. So I will make mention of this in the comments on Blackboard that accompany this video. I don't want to say anything specific in the video itself, but look how what I typed there and how it alludes to the chapter outline as to what I will expect you to know for the Unit 3 exam. So I hope this was helpful in your reading. I think, again, you'll see that what I'm saying here is what's most important for you to kind of know and understand to do well on the last exam in this course is contained in these first 4 sections of chapter 12. Okay, know those first 4 sections. You might have to refer to these last 2 to kind of get through the homework. But as far as the exam goes, exam goes, I want you to know these first four sections. So I hope this is helpful. Let me know if if you got any questions about any of this. We can always confer online, and I'll have more to say about the upcoming exam very soon. I hope you have a good evening, and I'll talk to you later. Bye bye.